And we are back, and what a day to be back on. What a way to start the week. Stock market's getting absolutely shredded. The dollar moving higher. Bond market all over the place. Commodities all over the place. And we have another busy week ahead. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here on Tasty Live. And what we are going to look at here is the macro catalysts that are going to feed what we have in front of us in the week ahead against the backdrop of a very difficult setting for financial markets. So what we're first going to do here is lay out some of the steps here on how we got here, what moved these markets, how we ended up with the moves that we're seeing, and what they're likely related to and what they're likely not related to, because there are certainly a plethora of narratives out there, and some of them make more sense than others. And then see how incoming economic data might change or indeed show up as tinder for these narratives, and see them extrapolate and find follow through. So let's begin with a look at how we have been moving last week versus the week before. And what you immediately see is that what we had last week was obviously very soft for equities. S&P down 1.6%. NASDAQ down not as much, but marking the third consecutive week of losses, which is the first time it's done that in 7 months. So clearly significant weakness in equities. Rates higher across the curve, the front end leading, up 3.1%. The back end a little bit softer, 2.8%. Nevertheless, rates higher. Crude oil and gold soggy relative to the prior week's performance, which is a very important bit here, it would seem. We'll talk in just a second about why. And the dollar meaningfully stronger, showing a little bit more strength against the yen, but they're a little bit more muted as relative to the benchmark, the euro. That's the most liquid US dollar cross. Almost a 2% gain for the dollar last week, and that was emblematic of how it did against most major currencies. Bitcoin down, but not as much as it had sold off the prior week, still on the weak side of things. The simple explanation here seems to be, of course, rates higher, risk off. And so with a hotter CPI number, we get hotter yields, we get weaker stocks, we get a stronger dollar. All of that makes sense. Another sort of explanation that emerged, in particular on Friday, looked to geopolitics as another kind of amplifying force, as you got these perpetual headlines saying that Iran was preparing to launch some sort of a direct strike against Israel, which, of course, subsequently we saw actually occurred over the weekend. Thankfully, almost all of the projectiles that were shot were intercepted. And so it doesn't look like we had a kind of terrible consequence, at least from that initial strike, in terms of its destructive power or what its destructive power could have been. But nevertheless, it looked like the markets were kind of jumping on those headlines, at least if we looked at the narrative as it was being described by market observers on Friday. And this is where it gets a bit strange. We, of course, had stocks down on Friday, bonds up, and rates down on Friday, signaling that we had risk aversion for reasons that were not necessarily having to do with a more hawkish Fed. Capital seemed to be running to the safety of dollars. You can see that here. But what we didn't see was the reflexive buying of gold that typically happens in a risk-off environment. We did not see crude oil surge, which typically happens in disruptions of the geopolitical calm in the Middle East, such that it is, or at least the geopolitical baseline. We did not see the oil-linked currencies like the Canadian dollar or the Norwegian krone perform well, which they typically do because crude oil is surging in those kinds of environments. In fact, both were down against the dollar, and the yen was flat against the dollar, as if to say capital went to the traditional anti-risk assets, dollar, yen, bonds. And it did not see outsized embrace of gold. It did not see outsized embrace of crude. It did not see outsized embrace of crude proxies, all of which seem to suggest that it wasn't really the geopolitics that were the quintessential narrative. It might have contributed to some extent. I think there's a very good argument to say that it did add into the stew, but it does not seem like it was the defining bit. Rather, that goes back to the idea that we've been talking about here seemingly forever on macro money, which is that when future capital starts looking more expensive to borrow than the baseline, risk appetite crumbles. And what we find here, S&P 500 in the blue as the stand-in for overall risk sentiment, what we find is that when in March the 20th, the Fed reaffirms its call for 3 cuts this year, whereas the markets from that point onward move durably to the hawkish side of that and say, no, you will not cut 3 times. You will cut once and maybe a second time. At this point, 36 basis points comes up to 1 full cut of 25 basis points and about a 57% chance of a second cut. So the market is dubious about even a second cut, never mind a third. When future money is more expensive, people don't want to take risks because if they lose the money on the risks, they have to borrow back more dear versus more cheap. And that is a fundamental difference in the story now versus anything that's happened since October. More rate cuts here meant the money was getting progressively cheaper. And although better than expected data was seeing the cuts narrow here since the beginning of 2024, not until the March 20th Fed meeting did we durably get to a place where the markets were more hawkish than policymakers in their expectations. We're there now, and so risk has started to unravel. Now, the week ahead is going to have no shortage of fundamental catalysts to feed this story. And the first comes from China. The expectation is that we're going to see a bit of a slowdown in growth from 5.2 to 5% on GDP numbers. We're also going to get industrial production and retail sales numbers, expectations that we're going to weaken on both of those, down to 5.4 year on year for industrial production and 4.5 year on year for retail sales. And if we look at the way that Chinese economic data has been behaving relative to forecasts, we see that it has at best stabilized around 0 on the economic surprise index here, which means that basically outcomes are broadly as expected, that reality is matching what economists have been pointing to. Most recently, though, we can see a bit of weakness. And so that might set the stage for weaker outcomes. If we continue to see anemic conditions in the world's second largest economy, that obviously adds insult to injury in an otherwise already risk-off market. And so, as if the markets needed something else to worry about, the inability of the world's second largest economy to get back up on its feet is just another in a quiver of worries. And so, now that we've lost this apparent insulation from these types of things, from future cheap money, and the money now looks like it's going to be more expensive, now this becomes a risk that might compound risk aversion. One of the major inflation releases for the week coming from the UK, expectations that we're going to slide to 3.1%. That would be a near 3-year low for UK inflation. And what we see in the breakdown of the constituent parts here is that food has receded, much like the Eurozone. This was the largest contributor all of last year. You can see it's significantly fallen back. And the remaining big pockets are in the discretionary spending side of life: recreation, hospitality. Now, these things you would expect to fade with a weakening economy, which, of course, has, in fact, according to the PMI data, transpired in the UK over the past several months. The pace of economic growth has been slowing. On the food side of things, we can see that, again, as with the Eurozone, there's about a 7-month transmission between where global food costs go and where inflation's going. So there seems to be quite a bit more tail here for the food component to build out and to continue to push this lower. So it would seem that this inflation data might set the stage for the Bank of England to move on rate cuts, perhaps even a bit faster or with a bit greater vigor than what is currently expected. If we look at the baseline expectations where they are now, we have 45 basis points in cuts. So that's one full cut and about an 80% chance of a second one. And the beginning of the easing is slated for August. If we get particularly soft numbers here, much as we did in the Eurozone, and for much the same reasons, then we are looking at perhaps sooner cuts and perhaps more of them, which not only bodes ill for the British pound, but more generally paints this story that the Fed is going to be more reluctant to cut than other central banks, widening out yield differentials between the dollar and other currencies, and again, giving the dollar a still further push against its major counterparts. That, of course, continues to be the story here. We can see Fed rate cut expectations fading because we have this hot inflation data and the markets are baking in a much less active Fed than they were before. There is an absolute slew of Fed speakers this week that are going to inform this narrative. So that'll be important to watch all through the week. Everybody, it seems, that could be talking is. We have speeches due from virtually every corner of the Fed universe. Speaking on Wednesday, Mester. Speaking on Thursday, Bostic and Williams. Speaking on Friday, Goolsbee. We've already had a speech from Lori Logan this week. So we're looking at quite a lot of opportunity to shape this narrative, even though the U.S. data docket isn't all that busy. So that'll be important to keep an eye on. And finally, Japan will have its inflation data out toward the end of the week. That's expected to be unchanged at 2.8%. But just like Chinese economic data has been relatively soggy compared with forecasts in Japan, it's been the other way. Data has increasingly outperformed expectations since the beginning of the year. If this comes in hotter, it might encourage speculation that the Bank of Japan might need to hike sooner than is currently expected, which of course would be an interesting thing considering the yen is at the lowest levels in 34 years. If these levels are indeed as troubling for Japanese authorities as their recent commentary seems to suggest, a hot CPI number that actually gives the yen a bit of a lifeline might be the kind of thing that encourages intervention. Japanese authorities don't generally like to intervene to fight markets. They like to let the markets turn and then give them a strong helping hand. If that CPI number gives us an upturn in the yen, that may very well be their cue to step in, giving us a much sharper yen rally than would otherwise occur. And that's something to keep an eye on. And that is macro money for today. Thanks very much for joining. As ever, we are here Monday through Thursday right after overtime. I'm back on Friday with Chris for Futures Power Hour. I am also on with Tom and Victor for First Call on Sundays. writing for the news and insights portion of tastylive.com, and opining on the platform formerly known as Twitter at @IliasPback. Thanks very much for joining. Happy trading. See you tomorrow.